Hey everyone, welcome to the channel. If you're prepping for the CPA exam, especially the FAR section, you're in the right place. Today, we're kicking off a brand new walkthrough series where we break down CPA-style questions, step by step, just like you'll see on test day. So, let's get into question 1.
Question. Golden Valley Gas, a U.S.-based energy company, has a subsidiary in Brazil. The subsidiary's functional currency is the Brazilian real, BRL. At the start of the fiscal year, Golden Valley Gas entered into a forward contract to hedge a forecasted purchase of equipment from a Brazilian supplier, expected to occur at the end of the fiscal year. The forward contract was designated as a cash flow hedge. The notional amount of the forward contract is BRL 2 million, and the forward rate at inception was $0.25 divided by BRL. At the fiscal year end, the spot rate is $0.27 divided by BRL, and the forward rate for the remaining term of the contract is $0.26 divided by BRL. Golden Valley Gas's controller needs to determine the appropriate accounting treatment for the forward contract at year end. Which of the following is the correct accounting treatment for the forward contract under ASC 815 and ASC 830?
The core concept here is understanding how to account for a forward contract designated as a cash flow hedge when dealing with foreign currency. It's every CPA candidate's favorite topic, the excitement of hedge accounting. Let's start by dissecting the scenario. Golden Valley Gas has entered into a forward contract to hedge a future purchase from its Brazilian subsidiary, making this a cash flow hedge, which means that the effective portion of any gain or loss on the derivative goes into other comprehensive income, or OCI, until the forecasted transaction affects earnings. The key here is to distinguish between the effective and ineffective portions of the hedge. Now, let's analyze each option. Option 1 suggests recognizing a gain of $20,000 in OCI. This is tempting because under ASC 815, the effective portion of the gain or loss on the derivative is indeed reported in OCI. In this case, the forward rate at year-end is 26 cents per BRL, which values the contract at $520,000 compared to the initial $500,000. The resulting $20,000 gain is what should be recognized in OCI. So, this option aligns well with the accounting standards. Option 2 proposes recognizing a loss of $40,000 in net income. This option can't be correct because the gain or loss recognized in net income should only happen when the forecasted transaction affects earnings. Here, we're dealing with the effective portion of a cash flow hedge, which must go to OCI. Option 3 suggests recognizing a gain of $10,000 in net income. This might seem right if we confuse the effective and ineffective portions of the hedge, but since the entire change in value of the hedge at the forward rate is effective, this option is incorrect. Option 4 mentions recognizing a gain of $20,000 in net income. This option can't be correct because, again, the effective portion of a cash flow hedge should be recognized in OCI, not net income. Based on our analysis, the correct answer is to recognize a gain of $20,000 in other comprehensive income. This answer adheres to the principles laid out in ASC 815 for cash flow hedges, ensuring that the effective portion of the hedge is appropriately recognized. For exam success, remember that distinguishing between what goes to OCI versus net income is crucial when dealing with hedges. And remember, nothing screams excitement quite like a perfectly hedged, forecasted transaction.
Question. As the controller of Riverbank Utilities, you are tasked with ensuring the company's financial stability amidst potential market volatility and a possible credit downgrade. The company has the following financial data. Current assets, $5 million. Inventory, $1,500,000. Prepaid expenses, $200,000. Accounts receivable, $2 million. Current liabilities, $2,500,000. Cash, $800,000. Riverbank Utilities aims to maintain a quick ratio of at least 1.0 to satisfy its creditors and align with industry benchmarks. Considering ASC 21010 on balance sheet presentation and ASC 223010 on cash flow classifications, Which of the following actions should Riverbank Utilities take to ensure it meets its quick ratio target while preparing for potential financial challenges?
The main concept this question wants us to grasp is the calculation and interpretation of the quick ratio, which is a measure of a company's ability to meet its short-term liabilities with its most liquid assets. In accounting speak, it's a way to see if you can pay your bills without having to sell off the office furniture. The quick ratio is calculated by taking current assets, subtracting inventory and prepaid expenses, and then dividing by current liabilities. This is all about liquidity, and it ties into ASC 21010 on balance sheet presentation and ASC 23010 on cash flow classifications. Let's dive into the options one by one. Option 1 suggests collecting $300,000 from accounts receivable. This option might make your heart sing because it increases your cash, which is a quick asset, and doesn't affect your liabilities. Increasing cash by collecting receivables directly beefs up the numerator in our quick ratio calculation. With $3,300,000 already in quick assets, adding $300,000 more brings us to $3,600,000. Divide that by our $2,500,000 in current liabilities, and we have a new quick ratio of 1.44. Sweet. Option 2 proposes increasing cash by $200,000 through a short-term loan. While it does improve liquidity, it also increases current liabilities, which is like trying to fill a leaky bucket. So this can't be correct, because although cash goes up, liabilities go up too, and your quick ratio might not improve as desired. Option 3 involves selling $500,000 of inventory at cost. This option might seem tempting because it generates cash. However, inventory is excluded from quick assets when calculating the quick ratio, so this doesn't provide the direct benefit we're looking for. Option 4 suggests using a $300,000 line of credit to pay down current liabilities. While this reduces the denominator, it doesn't directly increase quick assets, and it involves a bit of financial gymnastics that don't align with the straightforward approach of collecting receivables. Based on our analysis, the correct answer is to collect $300,000 from accounts receivable. This action strengthens the quick ratio by increasing cash without impacting liabilities, keeping us aligned with our liquidity goals. It's a classic case of show me the money, but in a balance sheet context. Always remember, when you're preparing for the CPA exam, focus on how the principles apply directly to the numbers. And remember, accountants may not always be the life of the party, but hey, we know how to keep the books balanced.
Question. Summit Fabrication, a manufacturing entity, is finalizing its consolidated financial statements for the fiscal year ending December 31, 2024. The controller, Alex, is tasked with ensuring the accurate presentation of other comprehensive income, OCI, in accordance with current ASC standards. During the year, Summit Fabrication recorded a foreign currency translation adjustment of $250,000 related to its German subsidiary and an unrealized loss on cash flow hedges of $150,000. Additionally, the company recognized a gain of $400,000 from the disposal of a segment, reported net of tax in the income statement. In preparing the Statement of Comprehensive Income, which of the following items should be included in OCI under ASC 220, ASC 830, and ASC 815?
Let's analyze what this question is really testing. The core concept here is understanding what items should be reported in Other Comprehensive Income, or OCI, in accordance with current ASC standards. Specifically, we need to look at ASC 20, ASC 830, and ASC 815. These standards guide us in classifying items that bypass the income statement and go directly to equity through Accumulated Other Comprehensive Income, or AOCI. Now, ASC 220 provides the framework for reporting comprehensive income, which includes both net income and OCI. ASC 830 deals with foreign currency matters, and ASC 815 addresses derivative and hedging activities. So the key principle here is identifying which transactions impact OCI and not net income. Let's go through each option. Option 1 suggests including only the foreign currency translation adjustment of $250,000. This option might seem plausible because ASC 830 clearly states that foreign currency translation adjustments are part of OCI, but it overlooks the unrealized loss on cash flow hedges, which ASC 815 also requires to be included in OCI. So this option can't be correct. Option 2 includes both the foreign currency translation adjustment and the unrealized loss on cash flow hedges. This aligns perfectly with the standards. ASC 830 and ASC 815 both dictate that these are OCI items, making this option a strong contender. Option 3 adds the gain on discontinued operations of $400,000 to the mix. This option might seem tempting because it includes all the items mentioned, but here's the catch. Gains or losses from discontinued operations are reported in the income statement, not OCI. This makes option 3 incorrect. Option 4 includes only the unrealized loss on cash flow hedges. Similar to option 1, this is a partial answer. While ASC 815 tells us this loss should be in OCI, it ignores the foreign currency translation adjustment, which is also required by ASC 830. Therefore, option 4 can't be right either. Based on our analysis, the correct answer is option 2. The foreign currency translation adjustment of $250,000 and the unrealized loss on cash flow hedges of $150,000. These items should be reported in OCI under the appropriate standards. Remember, when tackling OCI-related questions, always think about what bypasses the income statement and directly impacts equity. This will help you navigate the thrilling world of comprehensive income reporting with the precision of a seasoned CPA.
Question. Elmwood Education Services, a private educational institution, is preparing its financial statements for the year ending December 31, 2024. The institution holds a note receivable from a local government entity valued at $2 million due in 4 years with an annual interest rate of 4%. As the controller, you are tasked with determining the appropriate allowance for credit losses using the Current Expected Credit Losses (CECL) model under ASC 326. Given the current economic downturn and historical data, you estimate a 12% probability of default with a 35% loss given default. Considering the time value of money, what is the appropriate allowance for credit losses that Elmwood Education Services should recognize for this note receivable?
Right away, we know this question is testing us on the Current Expected Credit Losses (CEL) model under ASC 326. The core concept here is the calculation of credit losses, considering the probability of default, loss given default, and the time value of money. This is a classic example of how financial institutions need to account for expected credit losses over the life of a financial asset, aligning with the forward-looking approach of ASC 326. Now, let's break down each option to see which one stands up to scrutiny. Option 1 suggests an allowance for credit losses of $84,000. This might seem tempting because it's the direct result of multiplying the probability of default, the loss given default, and the exposure at default. However, this option doesn't consider the time value of money, which ASC 326 requires us to do for long-term assets. So despite its appeal, it can't be correct. Option 2 gives us $71,680. This result accounts for the time value of money by discounting the expected credit loss of $84,000 back to its present value using the note's interest rate of 4% over 4 years. Given the CECL model's emphasis on such forward-looking calculations, this option aligns perfectly with the standard's requirements. Option 3 presents $96,000. This figure might float around as a distractor, possibly stemming from an incorrect combination of the given percentages or an overestimation of the exposure. It doesn't fit our calculation framework or any logical derivation from the data provided. Finally, option 4 posits $80,000. This number could trick those who might have miscalculated the discounting aspect. Yet again, it isn't aligned with the calculated present value of the expected loss. Based on our analysis, the correct answer is $71,680. This reflects the discounted expected credit loss, taking into account both the risk of default and the time value of money, just as ASC 326 dictates. For the CPA exam, remember that when you see references to the SEAL model, always consider the time value of money as part of your calculation. It's like accounting's way of reminding us that money today isn't quite the same as money tomorrow, even if we accountants wish it were that simple.
Question. As the controller for the City of Stonegate, you are finalizing the fiscal year-end financial statements. During the year, the city issued $5 million in bonds to fund the construction of a new public library, recorded in the Capital Projects Fund. By year-end, $3,500,000 of these proceeds have been utilized for construction. Additionally, the city transferred $500,000 from the general fund to the debt service fund to cover the first year's interest payment. According to GASB 34 and GASB 54, how should the remaining bond proceeds and the transfer be reported in the financial statements for the Capital Projects Fund and the Debt Service Fund, respectively?
Let's identify the key accounting area this question is exploring. We're looking at governmental accounting, specifically how to report certain transactions and fund balances under the Governmental Accounting Standards Board GASB guidelines, particularly GASB 34 and GASB 54. These standards dictate how cities and other governmental entities should prepare their financial statements, emphasizing the classification of fund balances and reporting of transfers. Now, let's break down the options. The question asks how to report the remaining bond proceeds in the Capital Projects Fund and the transfer to the Debt Service Fund. Option 1 suggests reporting $1,500,000 as restricted fund balance in the Capital Projects Fund and $500,000 as an expenditure in the Debt Service Fund. This can't be correct because the $500,000 transfer is not an expenditure. In governmental accounting, transfers are reported as other financing uses, not as expenditures. Option 2 proposes reporting $1,500,000 as committed fund balance in the Capital Projects Fund and $500,000 as an other financing use in the Debt Service Fund. This might seem right because committed sounds serious, but it's not legally restricted. GASB 54 tells us that committed is for amounts constrained by a government's highest level of decision-making authority, but here the funds are legally restricted by the bond issuance terms, so they should be classified as restricted, not committed. Option 3 suggests $1,500,000 as assigned fund balance and $500,000 as an other financing source. This option is a bit of a head-scratcher. Assigned fund balance implies intended use, but lacks the legal or formal action required for restriction. Plus, classifying the $500,000 transfer as an other financing source implies an inflow of resources, which doesn't match the reality of the situation where money is going out. Based on our analysis, the correct answer is option 4. Report $1,500,000 as restricted fund balance in the Capital Projects Fund and $500,000 as an other financing use in the Debt Service Fund. The restricted classification aligns with GASB 54 as the funds are legally bound for the library construction. The transfer is correctly reported as an other financing use because it represents an outflow for debt service purposes. When preparing for the exam, always match the nature of the transaction with the appropriate fund balance classification, and remember that GASB loves its distinctions.
Question. Riverside Medical Center, a healthcare provider, identified that it had incorrectly classified $2,500,000 of expenses related to outpatient services as administrative expenses in its financial statements for each of the past 3 years. The controller, Alex, is preparing the 24 financial statements and must address this error. Considering ASC 250 and its impact on financial ratios and stakeholder decisions, how should Riverside Medical Center most appropriately correct this error in its 2024 financial statements?
Okay, so this question is focused on error correction in financial statements according to ASC 250. The core concept here is how to properly correct an error from prior periods in a way that provides accurate information to stakeholders. This is a crucial part of financial reporting, as it ensures that all financial statements accurately reflect the company's financial position. ASC 250 requires that when an error is identified in prior period financial statements, the entity must correct the error by restating those statements. This involves adjusting each prior period presented to reflect the correction and adjusting the opening balance of retained earnings for the earliest period presented for any cumulative effect of the error on periods not presented. Let's go through each option systematically. Option 1 suggests recognizing the total misclassified amount as an expense in 2024 and disclosing the error. This can't be correct because it doesn't restate prior periods. Simply lumping the error into 1 year would distort the financials of 2024 and mislead stakeholders about past performance. Option 2 talks about adjusting the 2024 financial statements prospectively. This might seem like a quick fix, but it can't be correct because ASC 250 requires retrospective correction, not prospective. Prospective adjustments are more for changes in accounting estimates, not errors. Option 3 suggests restating the financial statements for the prior 3 years and adjusting the opening balance of retained earnings for 2024. This is actually what ASC 250 prescribes. Restating ensures that each year reflects the correct information, maintaining the integrity of the financial statements. Option 4 proposes correcting the error in the current year's statements without restating prior periods. This can't be correct either because it ignores the cumulative effect on prior periods, which is necessary for accurate financial reporting. Based on our analysis, the correct answer is to restate the financial statements for the prior 3 years and adjust the opening balance of retained earnings for 2024. This approach aligns with ASC 250's requirements for error correction and ensures stakeholders have a reliable basis for decision-making. So, remember, when it comes to error corrections, the excitement of journal entries really lies in getting them right the first time, or correcting them correctly when we don't. All right, we're going to go ahead and skip this one for now. No shame in saving the boss battle for last.
Question. Maplewood Institute, an accelerated filer, is preparing its quarterly report on Form 10Q for the period ending March 31, 2024. On March 15, 2024, the Institute discovered a significant data breach that compromised sensitive student information. The estimated financial impact of the breach is $3 million, and it is expected to affect the Institute's reputation and future enrollment. Considering the requirements under Regulation SK and ASC 855, which of the following actions should Maplewood Institute take regarding the disclosure of this event?
The fundamental concept we need to understand for this question is the disclosure requirements under Regulation SK and ASC 855. It's like a thrilling detective story where our main character, Maplewood Institute, must navigate the complex world of financial reporting. The key principle here is that significant events that could materially affect a company's financial condition must be disclosed promptly. For an accelerated filer like Maplewood Institute, this means filing a Form 8K within 4 business days of a material event. Let's break down each option to see why they're incorrect or correct. Option 1 suggests including the data breach disclosure only in the Form 10Q because it allegedly doesn't meet the immediate disclosure threshold for a Form 8K. This option can't be correct because the data breach is significant and has a potential financial impact of $3 million. Under Regulation SK, such material events require prompt disclosure through a Form 8K, not just a Form 10Q. Option 2 proposes disclosing the data breach in a Form 8K only if the estimated financial impact exceeds $5 million. While this might seem tempting because larger numbers often feel more significant, it's actually incorrect. Materiality isn't determined by a specific dollar threshold alone. It's about the event's potential impact on the company's financial condition and reputation, which in this case is indeed significant. Option 3 suggests waiting to disclose the data breach until the actual financial impact is determined, arguing that preliminary estimates aren't sufficient for disclosure. This option can't be correct because ASC 855 requires entities to evaluate subsequent events for disclosure based on the best available information at the time. Waiting could lead to non-compliance with disclosure requirements. Based on our analysis, the correct answer is option 4. Disclose the data breach in a Form 8K within 4 business days of discovery, as it represents a material subsequent event. This aligns with both Regulation SK and ASC 855, ensuring compliance with disclosure standards. Remember, the CPA exam loves to test your understanding of materiality and timing in financial reporting. So, keep these principles in mind when tackling similar questions. Now, wasn't that more exciting than a balancing act of journal entries?
Question. As the controller of Pacific Lumber Inc., you are preparing the year-end financial statements. During the year, the company modified its existing stock option plan, increasing the fair value of the options by $150,000 from an original fair value of $500,000. Additionally, Pacific Lumber issued convertible preferred stock with a par value of $1 million, convertible into common stock at a rate of 1:5. The company has a policy to restrict retained earnings by the amount of any stock-based compensation expense recognized. Considering these transactions, how should Pacific Lumber adjust its retained earnings at year-end?
We need to focus on what specific concept this question is evaluating. Here, we're diving into the world of stock-based compensation under ASC 718 and how it impacts retained earnings. The question is testing your understanding of how modifications to stock option plans affect financial statements, specifically retained earnings adjustments. The key accounting principle being applied is the treatment of stock-based compensation expenses. According to ASC 718, when you modify a stock option plan, the incremental fair value from the modification must be recognized as additional compensation expense. This means you add the original fair value of the options to any increase in value due to the modification to determine the total expense. Now let's systematically analyze each option. Option 1 suggests restricting retained earnings by $650,000 for the total stock option expense, including the modification. This option might seem like it's jumping the gun, but actually, it's the right approach. ASC 718 requires recognizing the full $650,000 as compensation expense, which Pacific Lumber's policy then restricts in retained earnings. Option 2 proposes restricting retained earnings by $500,000 for the original stock option expense. This option might seem plausible because $500,000 was the initial expense. However, it ignores the modification's impact, which ASC 718 mandates be included. Alas, no shortcuts in accounting. Option 3 offers restricting retained earnings by $150,000 for the modification only. Tempting, I know, because who doesn't love focusing on the shiny new number? But this overlooks the original expense, giving you a partial picture, and thus incorrect. Option 4 suggests restricting retained earnings by $1,150,000, including the convertible preferred stock. This option can't be correct because ASC 50510 treats convertible preferred stock as a separate equity transaction. It doesn't affect retained earnings for stock-based compensation purposes. Based on our analysis, the correct answer is option 1, restrict retained earnings by $650,000 for the total stock option expense, including the modification. This aligns with ASC 718's requirements and Pacific Lumber's policy to restrict retained earnings by recognized compensation expenses. Remember, on the CPA exam, understanding how different transactions impact financial statements is crucial. And don't worry, just like a good reconciliation, it all adds up in the end.
Question. Riverside Home Goods issued $5 million of convertible bonds on January 2024 with a 5-year term and a 6% annual coupon rate, payable semi-annually. The bonds were issued at a premium with an effective interest rate of 5%. As the controller, You are preparing the financial statements for the fiscal year ending December 31, 2024. In accordance with ASC 47020, calculate the interest expense for the first semi-annual period using the effective interest method and determine the appropriate amortization of the bond premium. Consider the impact of ASC 815 on the embedded conversion option, which does not affect the interest expense calculation. What is the interest expense for the first semi-annual period?
The first thing to recognize is that this question is about the effective interest method under ASC 47020, which deals with debt with conversion and other options. The core concept here is to calculate the interest expense for bonds issued at a premium using the effective interest rate rather than the coupon rate. The focus is on understanding how the carrying amount of the bond impacts interest expense calculations, a favorite topic for the CPA exam. ASC 47020 requires interest expense to be calculated based on the carrying amount of the bonds. In this case, the bonds were issued at a premium, meaning the carrying amount is higher than the face value. The effective interest rate will be used to determine the interest expense, which reflects the true cost of borrowing. Let's go through each option methodically. Option 1 is $125,000. This option can't be correct because it uses the coupon rate of 6% divided by 2, applied to the face value of $5 million, which doesn't consider the premium or the effective interest rate. Option 2 is $131,250. This option might seem right because it considers the effective interest method. Using the effective rate of 5%, the interest expense for the first semi-annual period is calculated as $5,250,000, the carrying amount times 5% divided by 2. This results in $131,250, which aligns perfectly with the principles under ASC 47020. Option 3 is $150,000. This might seem tempting because it represents the cash paid based on the coupon rate. However, it doesn't account for the premium amortization or the effective interest rate, which is crucial for accurate financial reporting. Option 4 is $137,500, a nice number, but purely fictional in this context. It doesn't fit the calculation methods required by the effective interest method and is likely included to confuse those who are rushing through the math. Based on our analysis, the correct answer is $131,250. This option reflects the use of the effective interest rate method, incorporating both the premium and the true cost of borrowing over the bond's life. Remember, the examiners love to test your understanding of how the carrying amount and effective interest rate interact. So, keep these concepts in mind as you tackle similar questions on the exam. It's all part of the exhilarating world of accounting standards, where every number tells a story. All right, now that we're done all of the multiple choice questions, let's get back to the final boss.
Scenario: you are preparing the year-end financial reporting for Development Holdings LLC, a publicly traded real estate investment company. The company signed a 5-year franchise agreement involving both upfront setup services and ongoing performance obligations. As part of year-end procedures, you are required to assess revenue recognition under ASC 606, classify liabilities, and calculate compliance with a key financial covenant related to the debt service coverage ratio, DSCR. Review all exhibits and complete the tasks.
Let's walk through this task-based simulation together, step by step, just like you would under exam conditions. So grab your calculator, or at least your brain's calculator, and let's get into it. Task 1. Calculating the DSCR. The debt service coverage ratio is a financial covenant that tells us how well the company can meet its debt obligations. The formula is net operating income plus depreciation divided by principal plus interest. So let's start with Exhibit 3. It says the DSCR must be at least 1.10 to comply with internal and lender policy. Now flip to Exhibit 1, the trial balance. Look at interest expense, $28,000, and principal repayment, $122,000. Add those together, and your total debt service is $150,000. Now let's find the numerator. Revenue is listed as $168,000 and depreciation expense is $30,000. That gives us a numerator of $198,000. So now 198 divided by 150 gives us a DSCR of 1.32. That's comfortably above the minimum requirement. So task 1, done. But don't forget to reference your exhibits when you're pulling numbers and state the formula out loud as you go. Task 2, the Revenue Journal entry under ASC 606. Open up Exhibit 2, the franchise agreement. It tells us there's a one-time setup fee of $100,000 and ongoing support of $400,000 spread over 5 years. That's $80,000 per year. Now check Exhibit 4, the internal memo. It says the setup was fully completed in Q1 and 17% of the support services were delivered this year. So 17% of $400,000 is $68,000. Add that to the $100,000 setup fee and total recognized revenue for the year is $168,000. Now let's record it. Debit deferred revenue for $168,000 and credit revenue for $168,000. This reflects delivery of performance obligations during the year. You didn't earn everything, but you did earn part of it. And ASC 606 requires you to recognize that portion now. Task 3. Classify the deferred revenue between current and non-current. Go back to Exhibit 1 again and find the deferred revenue account. It shows a balance of $332,000. From Exhibit 4, we know that revenue will be earned evenly over the next 4 years. So divide 332 by 4, that's $83,000 per year. That means $83,000 will be satisfied within 12 months, so that's your current portion. The remaining $249,000 is non-current. This classification affects liquidity ratios and financial statement presentation. Don't just toss everything into current. Follow the guidance. Task 4. Selecting current liabilities under U.S. GAAP. Let's take a careful look at Exhibit 1, the trial balance. We're being asked to identify which of these accounts should be classified as current liabilities on the balance sheet as of year-end. And remember, GAAP says current liabilities are those due within 12 months or within the normal operating cycle, whichever is longer. So let's walk through the options. Option A, notes payable due March 2026. That's within 12 months of December 31st, 2025. So yes, this is a current liability. Option B, unearned revenue from 2027 services. That's more than a year out, and performance won't happen until 2027. So this portion should be classified as non-current. Option C, accrued expenses. These are usually short-term obligations like wages or utilities, unless stated otherwise. Since the exhibit doesn't tell us otherwise, we'll treat this as current. Option D, lease liability, long-term portion. Keyword here, long-term. That means this part is not due within the next 12 months, so it stays in non-current liabilities. Option E, deferred revenue, portion due within 12 months. Yes, this is current. From Task 3, we know that $83,000 will be earned next year. So we've already done the math. Option F, accounts payable. These are classic short-term obligations, usually paid within weeks or months. So yes, definitely current. Option G, interest expense. Now this is a trick option. Interest expense is an income statement account, not a liability, so it doesn't belong in this classification at all. So the correct current liabilities are A, C, E, and F. That's your answer. And just as important as selecting the right items is knowing why the wrong ones don't belong. Now, Task 5. This is a judgment call question about revenue recognition and uncertainty. Open up Exhibit 4, the internal memo. It says a franchisee may not continue participating in future training sessions. That raises a red flag. Because under ASC 606, this introduces variable consideration. Let's walk through your answer choices. Option A says, defer all revenue until the contract is complete. That might feel cautious, but it's too extreme. We've already delivered some services like the onboarding and part of the training, And under ASC 606, we have to recognize revenue as performance obligations are satisfied. So this one's overly conservative and non-compliant. Option B says recognize only the upfront fee and defer the rest. But wait, we've satisfied 17% of the ongoing support services. That portion should be recognized too. Ignoring it means understating revenue. So option B is incomplete. Option D says recognize all revenue immediately since control transferred at signing. That's aggressive. Even if the contract was signed, control transfers as performance happens, not just when the ink dries. Most of the services haven't even been delivered yet. So this is too much. Too soon. That leaves option C, recognize revenue as performance obligations are satisfied, and reassess variable consideration if there's uncertainty about the future. This aligns perfectly with AS 606, Section 1055. It captures the revenue you've earned while staying cautious about anything still up in the air. So, the correct choice is C. And that wraps up Task 5. Big picture. This entire simulation tests whether you can apply the rules of ASC 606 in real-world conditions, calculate financial ratios with context, and make thoughtful decisions about classification and timing. Keep referencing those exhibits, follow the math, and think like the examiner. You're not just checking boxes, you're showing that you understand the story behind the numbers. All right, that's it for today's walkthrough. If you found this helpful, make sure to like the video and subscribe for more deep dives into CPA exam practice. We'll also be covering auditing and attestation, regulation, tax compliance and planning, business analysis and reporting, and information systems and controls, so stay tuned. Until next time, keep practicing, stay focused, and trust your process.